If you've grown your business in revenue and size, but are finding yourself in a situation where you're making less money and having more hassles than when your business was smaller, or if you are in the process of starting to grow your business and don't want this to happen to you, then this video is for you. The reality is, at a certain point, as a business is growing, the demand for a company's products and services reaches a point where additional resources are required to continue to meet the increasing demand. Now, these additional resources will result in an increase in the fixed costs of the company. Now, this increase in fixed costs is not necessarily offset by an immediate and proportional increase in the revenue of the business. And as a result, there is a drop in profit because of the investment in additional resources that is only recovered at a later point when revenue has been increased. And so the best way to look at this is to look at the following simple example. So on the screen you have a graph of a company. Now this company does company registrations. It charges 500 Rand per registration and has a single employee earning 15,000 Rand a month. That employee can do up to 84 registrations a month. And so the company pays 15,000 Rand for the employee, and at its maximum capacity, it can generate 42,000 Rand a month in revenue and make a 27,000 Rand profit. And that's represented by the green arrow on the graph. Now, the challenge that this company faces is that if it wants to increase the number of registrations it does per month, it has to make a big upfront investment in a second employee, increasing its fixed costs from 15 to 30,000 Rand per month. And so when it makes that investment and increases the capacity, there is a drop in the level of profitability represented by the red line or the red arrow. However, as the company increases the amount of registrations it does, the investment pays off as shown by the amount of profitability that is achieved by the blue arrow. And so this makes sense. You invest in additional capacity, the initial cost decreases your profitability, but then you see increased profit as revenues grow. But why doesn't this happen for many businesses that make that investment? The reason for this is, using the example on the screen, is that we have to increase company registrations from 84 to 114, which is a 36% increase in revenue, for us just to make the same level of profitability. And for so many companies, as demand grows, we add additional resources, mainly in the form of staff, but possibly additional facilities, and we don't make a sufficient return on these investments. And this is either due to inefficiencies in the management of those additional resources, or we just simply don't have the ability to generate additional sales to fill the capacity that we've created in the business. So how do we manage this risk in a growing business? We do that by the following three ways. The first of them is to set a target range for net profit so that we're always managing the growth in the business within a range of profitability. The second is to track and manage our labor efficiency ratio to ensure that the additional staff and labor we add to the business generates the right level of output to make a return on that investment. And the third is to forecast out how our costs and profitability will change with increasing revenue so we can manage the business growth against that. So let's look at each one of these in turn. So to manage the growth of business profitably, Greg Crabtree, in his book Simple Numbers, Straight Talking, talks about first setting a minimum net profit margin. Now, Greg advises in the book that at a 5% net profit margin before tax, your business is really on life support and doesn't have sufficient funds to grow the business unless you're going to raise capital from external investors. You should be ideally operating at about a 10% net profit margin, and then looking to grow that to about 15% before investing for future growth. And so in other words, your profit margin is below 10%, you should be looking to fix this and improve the efficiencies within your existing business to get the profit margin up, and then use that profit to reinvest in growth and then drive the profitability back to your target profit margin. For some businesses, just as a note, they operate well below 5% in terms of net profitability margin. Now, these businesses, their revenue number reflects sales of products and services on what we call a flow-through basis, where the revenue of the sale is recognized in the books of the company, but the value added by the company is small relative to the value of the product sold. In these types of companies, it's maybe better to calculate the net profit margin on gross profit, reflecting the value added, rather than on revenue. Examples of such companies would be, construction companies, where the profit margin really reflects a fee for the project management and the building of the building, rather than a return on the cost of all the materials used in the construction. So in summary, you need to be ensuring that you're operating at a high level of efficiency in achieving the right minimum or target net profit margin. Then you invest for growth, and you need to then drive your profitability back to that target margin to ensure that you have made a return and operating efficiently on that additional investment. The second one is your labor efficiency ratios. So what we're looking to do here is track the return that you are making on your employee costs. And so it's best to start this by calculating your labor efficiency ratio to determine how much gross profit do you generate for every rand of employee cost. At its simplest form, it would be gross profit divided by your total employee cost, both salaries and wages. But as most businesses have different kinds of employees, you can break this ratio out to look at the efficiency of different groups of employees. So there's three different potential ratios you could calculate. The first is your labor productivity ratio that would look at the return on employee costs directly incurred in the production of a product or service. I mean, this would typically be factory workers in the case of a manufacturing company, or in the case of a service company, employee costs of the staff that provide the service. The second ratio would be your sales productivity ratio, where we would look at the return generated on the employee cost for sales and marketing personnel. And the final ratio would be your management productivity ratio, where we would look on the return on employee costs incurred in the administration, finance, and management of the overall company. The management productivity ratio is often the ratio in a growing business that doesn't yield the required rates of return, because we're having to hire expensive management people to manage the growing team, but there's not a focus from a measurement of the productivity of management that investment in the management is yielding a significant increase in gross profit to justify that investment. So you need to be setting targets for these ratios, and then you need to, where you make an investment in the business, ensuring that the ratio returns to that target level to support the investment that you've made. And then the final one is to forecast how costs and profit will change with revenue growth. And so this is an example of a client that we worked with, and he had, worked for 8 years building his business. He had grown it to 15 million rand in turnover, but was very disheartened and discouraged that, his business wasn't ever making a profit. And in the year that we worked with him, in fact, it made a loss. And so what we did was we looked at it and said, well, can we grow this business and keep the fixed costs relatively constant, and by doing so, increase the profitability of the business? Or is it a case that even if we grew the revenue, fixed costs would continue to grow, and as a result, we wouldn't make a lot of additional profit? If that was the case, then we needed to come back and address the operating cost structure of the business, as the business wouldn't be profitable with that operating cost structure. But what we did was we looked at the growth in the revenue, we looked at how fixed costs would change, what additional staff resources would we need, any additional warehousing space or delivery vehicles, and we forecasted out what those would be. And as you see in the forecast, that the business becomes increasingly profitable as revenue grows, but once it reaches the 30 million rand turnover, profitability dips again slightly, because then there is a further need to invest in additional operating expenses. Part of this process was we recognized that his gross profit margin also was too low, and so we forecasted a 2% increase in the gross profit margin, mainly as a result of improving stock control and reducing the level of stock losses that the business was experiencing. Now, the good news is that this particular business owner followed this growth map for his business. He was able to retain his operating costs in line with the levels we set for increasing revenue. And the good news was he was able to improve his gross profit margin to a level that was better than what we had originally targeted for in this forecast. The net result was that after 3 years, this particular business owner was running the business at net profit margins well in excess of the 10%, and had created for himself a very nice profitable business, doing somewhere in the order of the 30 million turnover, but making in excess of 3 million profit, which obviously was a big contrast to the business we had started with when we started working with him. So in summary, the drop in profitability will occur when we're investing ahead of growing revenue in a business. We need to ensure that that investment generates us an appropriate return. There's 3 ways we can manage that. 1, by setting a target net profit margin, and when that profitability drops as a result of investment, working to get that profit margin back again to demonstrate we've achieved a return. 2, measuring our labor productivity ratios across different employee groupings to ensure that we're getting the right level of productivity and output for the investment made. And then the final way is to build a forecast of how revenue and costs will change as your business grows, so you know your business can achieve a certain level of profitability at different revenue levels, and then to manage the business to achieve that. If you need any further information on this particular topic, or would like to discuss this or any other business matter with us further, please contact us either via our website or on our telephone line. Thank you.